Hey everyone, Tim Hill here, your go-to mortgage broker, right here in the heart of Vancouver, BC. If you're a first-time buyer, sweating over those sky-high rates, a homeowner eyeing a refinance, or just someone who's tired of watching our housing market do the cha-cha, buckle up. Yesterday, September 17th, 2025, the Bank of Canada dropped a bombshell. They slashed the overnight rate by a full quarter point to 2.5%. That's the first cut since March, folks. And get this, it happened on the exact same day the US Federal Reserve did the same thing. Coincidence? Hardly. This isn't just numbers on a screen. It's real money back in your pocket for that dream condo in Yaletown or family home in East Van. Today, we're breaking it all down. What this means for your mortgage payments, how it could juice up home prices in our rainy city, and my no BS projections on where rates are headed through the end of 2025 and into 2026. Stick around. This 15-minute deep dive could save you thousands. If you're new here, hit that subscribe button and ring the bell for more Vancouver-specific mortgage hacks. First things first, what exactly went down with the Bank of Canada? On September 17th, Governor Tiff Macklem and the Governing Council unanimously voted to lower the target overnight rate from 2.75% to 2.5%. The bank rate's now at 2.75%, and the deposit rate sits at 2.45%. Why now? Inflation's cooling off. It's hovering right around that sweet 2% target, but our economy's showing some cracks. Unemployment's ticking up, job growth's sluggish, and consumer spending? Not so hot. The BoC's basically saying, hey, we've tamed the inflation dragon. Time to give the economy a gentle nudge. This isn't a wild pivot. Markets were pricing it in. But it's a big deal because it restarts the cutting cycle after a pause back in the spring. For us in Canada, especially on the West Coast, where affordability's been a punch to the gut, this is like finally catching a break after years of rate hikes. But here's the kicker. This cut flows straight through to the big banks. RBC, TD, CIBC, BMO, they're all dropping their prime rates to 4.7% effective immediately. That's the benchmark for a ton of loans, including your variable rate mortgage. More on that in a sec. Now, you can't talk BoC without shouting out the elephant in the room. Or should I say, the eagle. The US Federal Reserve. On the very same day, September 17th, the Fed chopped their federal funds rate by 25 basis points too, bringing it down to that 4% to 4.25% range. It's their first cut in 9 months, since last December. Jerome Powell's crew cited a softening job market and inflation easing toward 2%, much like our story up north. Why does the Feds yank Canada's chain? Simple. We're basically America's polite neighbor, who's way too dependent on them. Our economies are glued together. Think trade, exports, and that pesky Canadian dollar. If the Fed keeps rates higher than us, the loonie weakens, which makes US imports pricier and could stoke inflation here. So, the BoC often dances in step to keep the exchange rate stable around that 0.72 to 0.75 USD mark we've been hovering at. This synchronized chop? It's a sigh of relief for cross-border folks, but it also amps up the pressure. If the Fed signals more cuts, and their projections show 2 more this year, expect the BoC to follow suit to avoid a currency roller coaster. In Vancouver, where we've got so many US investors eyeing our tech scene and film industry, this tandem easing could mean more greenbacks flowing into our market. But it also means we're not calling all the shots. Uncle Sam still has a big say in our backyard. All right, let's get to the good stuff. How this hits your wallet on mortgages. As a broker who's helped hundreds of Vancouverites lock in deals from Kitsilano lofts to Surrey semis, I can tell you, this cut is a lifeline for borrowers. If you've got a variable rate mortgage, and about 1 in 5 Canadians do, your payments drop like a stone. Banks pass on the prime rate change pronto, so you can expect your lender's rate to shave off that 1/4%. For every $100,000 you owe, that's roughly $15 less per month in interest. On a $500,000 mortgage, boom, that's $75 a month saved, or $900 a year. Over 5 years, you're looking at nearly $4,500 back in your jeans for that extra trip to Whistler. And the best rates out there? The lowest 5-year variable is dipping from 3.95% to around 3.7 right now. If you're shopping, I can hook you up with options under 3.5% after discounts. Fixed rates? They're a bit stickier, tied more to bond yields, but even those are trending down. 5-year fixeds could slide another 10 to 20 basis points in the coming weeks, making them competitive again if you're risk averse. Bottom line, borrowing power jumps. That stress test? Suddenly easier to qualify for a bigger loan. A family pre-approved for $600,000 last month might now stretch to $650,000 without breaking a sweat. In Vancouver's cutthroat market, where the average home's still north of 1.2 million, that's the difference between maybe next year and let's make an offer. So, does this mean Vancouver's housing market finally shakes off the dust? Short answer, it's a boost, but not a magic wand. Our market's been in the doldrums. Sales are picking up a tad this September, up maybe 5 to 10%, month over month. But prices? Still sliding in the condo segment, down 2 to 3% year over year, while detached homes hold steady around 2 million. The rate drop eases the pain on affordability. Buyers who sat on the sidelines during the high rate hangover are peeking back in. Expect more multiple offers scenarios in hot spots like Mount Pleasant or Olympic Village as borrowing costs dip. For sellers, it's a green light to list now before competition heats up. But let's be real, bigger headwinds loom. Unemployment in BC is at 6.2%, tech layoffs are biting, and those US tariff threats under a potential Trump 2.0? They could slam our lumber and auto exports, cooling things further. From my broker's perch, I've seen a 15% uptick in inquiries since yesterday. Folks renewing variables are thrilled, and first-timers are recalculating budgets. Prices might firm up, maybe 3 to 5% by year end if cuts keep coming. But honestly, don't bet on a boom. Vancouver's still a seller's market at heart, just with a friendlier entry door these days. All right, crystal ball time. Where do rates go from here? Based on economist consensus from CIBC, RBC, and the BoC's own vibes, I'm calling another 25 basis point cut in October, landing us at 2.25% by Halloween. That'd be the low end of neutral territory, giving the economy some breathing room without overheating. End of 2025, hold steady around 2.25%. Maybe one more trim in December if jobs data stays soft. No wild rides. The BoC's data dependent, watching inflation like a hawk. Into 2026, projections get a bit fuzzier, but most forecasts see a gentle climb, back to about 2.5 to 2.75% by mid-year as growth picks up and the Fed normalizes. Bond markets are betting on stability, but hey, watch for election drama south of the border. If tariffs bite, we could see prolonged lows. Otherwise, a soft rebound. As your Vancouver broker, my advice? Lock in now if you're fixed rate shopping. Rates won't plummet forever. Variables? Great if you believe in more cuts. Ooh, that's the scoop on the Bank of Canada's big move, from Fed ripples to your next mortgage payment. If this sparked questions, drop them in the comments. Tim, should I refi now? Or what's the vibe in Burnaby? Hit like if you're feeling optimistic about Vancouver real estate, and subscribe for my weekly breakdowns. Ready to crunch your numbers? Reach out for a free 30-minute consult. No obligation, just straight talk from a local who gets it. Thanks for watching. Here's to lower rates and higher hopes. See you next time.